Have you ever seen a company report what looks like absolutely fantastic news, only to watch its stock price completely tank? Well, that's exactly what happened with SanDisk. They had a great quarter, but the market's reaction, it was a total head-scratcher. I mean, just look at this. On one side, you've got the results, a huge beat on revenue, an even bigger beat on earnings. This is the kind of report card that should have investors popping champagne. But then you look at the other side. The stock plunged 11% after hours. So what happened? It's this classic Wall Street puzzle, right? The good news was clearly not good enough. In this explainer, we're going to dig in and unpack exactly what went down. First, let's just lay out all the good stuff. Let's build the case for why Wall Street should have been absolutely thrilled with this report. It all starts with the top line, the revenue. SanDisk pulled in over $1.9 billion. That's a huge number, and it was up a solid 12% from the quarter before.
And then there's the bottom line, earnings per share, coming in at 29 cents. Now that's impressive on its own, but these numbers get way more powerful when you see what everyone was actually expecting them to do.
And here's where it gets kind of crazy. See, analysts were looking for about $1.83 billion in revenue. SanDisk beat that by $75 million. But the real jaw-dropper was the earnings. The consensus was for just 3 cents a share. SanDisk delivered 29 cents. That's not a beat, that's a blowout. And this wasn't just a one-time thing. Management's forecast, their guidance for the next quarter, was incredibly strong. They said revenue would jump another 13%, and earnings would more than double from here. The momentum was undeniable. And if you looked under the hood, the company was just getting healthier. They were cutting their debt and managing their inventory way more efficiently. I mean, everything here is pointing up and to the right. So the mystery just gets deeper. Okay, so on top of these stellar financials, SanDisk was also painting this really exciting picture of its future. They were positioning themselves to be a huge player in the whole AI revolution. This is the long-term story that should have gotten investors fired up. Management laid out this simple 3-part strategy. First, get their next-generation memory, BiCS8, ramped up. Second, push their new high-density platform for data centers. And third, this really intriguing new thing they called high-bandwidth flash. So what in the world is high-bandwidth flash, or HBF? Well, you can think of it as a brand new type of memory built specifically for the insane data demands of AI. It's like a superhighway for all the data that AI models need to do their thing, solving a big bottleneck for engineers. And management was not shy about this. On the earnings call, they literally said HBF is a new paradigm for AI. They don't see this as just a small step forward. They see it as a total game changer for how AI systems are built. And to prove how serious they were, they announced a massive partnership with SK hynix, one of their biggest rivals. Why would they do that? To make HBF an industry standard. It's a classic move. If you can get the whole industry to use your technology, you've just created a huge long-term market for yourself. Okay, so let's recap. We've got record results, a super strong forecast, and this compelling AI story for the future. So now we finally have to get to the heart of the mystery. What was hiding in the details that made the market freak out? Well, it turns out it wasn't about the revenue or the earnings or that big AI vision. The pros, they zoomed in on one very specific metric, gross margin. And here it is. This is the hidden story. SanDisk reported a gross margin of 26.4%. But, and this is the key, baked into that number were almost 5 full percentage points of one-time costs from starting up new factories. If you strip those out, the company's real underlying profitability was a much healthier 31.3%. Let's break those costs down. We're talking $42 million in startup fees and another $51 million in charges for not running the factories at full capacity. But here's what really set off the alarm bells. Management said those startup costs were actually going to increase to $60 million in the next quarter. But, and this is so important, management also gave everyone the context. They laid out a clear timeline for when these costs would go away. They said they'd drop big time in the second quarter and be pretty much gone by the third. So the issue was temporary, but in the short term, it was a big enough worry to overshadow all the good news. So, let's put all the pieces together. What does this whole contradiction, great results, but a falling stock, really tell us? Well, first, it's a textbook case of what traders call a sell the news event. The market was already expecting a strong comeback from SanDisk, and the stock price had already run up a lot.
So when the good news finally hit, investors just took their profits and focused on those short-term margin issues.
This really leaves us with two competing stories for SanDisk. You've got the bull case, which is all about the long game. The industry needs more of what they make, they have this clear AI vision, and their new tech will be a huge advantage down the road. Then you have the bear case, which is focused right here, right now. That short-term hit to margins and the risk that comes with trying to launch brand new, unproven technologies. And that brings us to the central question for anyone looking at SanDisk today. The company is choosing to take some pain right now, these startup costs, to make a massive long-term bet on the future of AI. So the question isn't just about one quarter's results. It's whether you believe that big, expensive bet is ultimately going to pay off.